Welcome to Stifel's Investment Strategy Brief, a monthly recap of the macroeconomic and market environment. Well, greetings and welcome to the Investment Strategy Brief podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. So it's February 2026. Artificial intelligence is just all the rage. People are talking about it. People are talking about using it, implementing new things. It's sort of stirred up quite a lot of optimism and sort of a recognition that there's lots and lots and lots of opportunities. But also when it comes to competition and maybe missteps, maybe over-investing, whatever it might be, risks associated with it. And then more recently, I would say for certain industries, some fear that's sort of baking into the market. So generally things have been positive, but there are these pockets of fear. So that'll be one of the threads that we get into in this episode. I will take the opportunity to kind of remind our listeners to check out Outlook 2026 Rewiring Growth, which we published last month. It does get into the idea that AI is going to help kind of create a sort of improvement in productivity. It's a report with a lot of different articles around artificial intelligence, things going on in DC, geopolitics. We get into fiscal trajectory, which we'll talk about here. So just invite people to check out the report. And again, we'll go over some of our views as we look forward. When it comes to politics, geopolitics, things have actually been reasonably stable in DC. Brian Gardner, Stifel's chief Washington policy strategist, penned an article in our Outlook around what we're headed for into 2026. Of course, it's a midterm year, decent probability that we end up with divided government. There's a focus on affordability and worry about the economy, even though things are looking pretty positive, and worry about things like trade and tariffs, changes at the Fed, et cetera. So we'll get into all that. And we do kind of continue to monitor geopolitics, things like U.S.-China competition, which is happening, but then, monitoring things for policy error, cyber attacks, just high impact risks, but we don't see super meaningful expectation that things are going to happen. So think of it as a process for monitoring the risks, but things, knock wood, seem kind of stable at this point. Now we do sort of break out military conflicts. Same thing. We see a lot of different conflicts around the world, obviously big human cost, but not a big impact on the global economy, and therefore not a big impact on markets as we see it at this point. But again, we're in the sort of in the process, as we always are, just monitoring those circumstances. So turning back to the economy, I'd say that things are turning out to be a little more positive than expected. So we've gone a bit above trend growth recently. That's certainly influenced by an active consumer. So even though we see confidence and sentiment sort of fading relative to long-term averages, basically the consumers remain engaged. That's probably supported by a solid labor market. So we've seen a little bit of softening, really more in terms of hiring. We're in sort of a no hire, no fire state right now, where there's just stability. People are sort of staying in their jobs a little more than normal. There's not as much many openings out there. And yet, against all that backdrop, we're at almost full employment. So unemployment, that rate's sitting at 4.3%. So that's below the 10-year average, well below the 10-year average before the pandemic, and well below the numbers we saw in the reopening during the pandemic. So think of it as, the job market hanging in there, but softening a little bit. A second dimension to the Fed's dual mandate is inflation. And so the latest prints have consumer inflation coming down close to, but not quite all the way to, the Fed's 2% target. And this is something that's in focus for the Fed. So they're going to say, hey, job's not done yet. They're mindful of inflation and where things are going. Now, we saw the announcement of Kevin Warsh as the nominee to be the next Fed chair and FOMC chair. And basically that caused all of us to kind of take a look at who this person is, basically some experience on the Fed before. He basically has a hawkish reputation, so generally likes to control policy with rates. And if there's any question about inflation. He tends to like to keep rates a little bit elevated, which is interesting. He's shown some of his views through a review of the Bank of England that he did. He basically favors private sessions for open debate, but then transparency and accountability on how people vote and set policy. He also tends to like monitoring more real-time market data over sort of survey and delayed data when it comes to monitoring what's going on and how the policy might be affecting things. Finally, he's not a big fan, so has expressed discomfort over the size of the Fed's balance sheet. He thinks interest rates are the better place to manage policy. And so we should expect, sort of a continued reduction in the size of the balance sheet under his leadership to the degree he can influence the committee that sort of ultimately sets the policy. So again, maybe not super dramatic an appointment, but he still has to be approved, and we'll see how that all unfolds. One sort of measure of reasonableness is the Fed funds target rate futures didn't really move in the wake of his announcement. Meaning that there's still an expectation of 2 cuts later in the year. And basically that didn't move a lot in the wake of his announcement. So that's something, again, that we're keeping a close eye on. But that's actually pretty much in line with our view. We think there's 1 to 2 cuts, quarter point each, from the Fed later in the year. Now, turning more broadly to the fiscal circumstance, so the fiscal side of things, we've talked about this before. We've got an activity basically of essentially almost $2 trillion a year in deficit for the federal government, adding up to a buildup of debt, which we think longer term is not sustainable. So we talk about it a lot. We talk about the fact that the cost of debt, the interest payments, are becoming a more meaningful part of our federal budget. We think it needs to be addressed. We did pen an article, Fiscal Trajectory, Borrowed Time, in our Outlook report, and 4 different scenarios on how things might unfold, from a very sort of negative one, which is, hey, there's going to be a reckoning and some real trouble in terms of a severe economic downturn, recession, or worse. And then the more positive side of things, sort of growth renaissance, meaning, hey, a little bit of austerity, maybe a little bit less spending, maybe a little bit higher taxes, but then maybe a lot of economic growth leading to more taxes. And we see ourselves, quote unquote, grow out of the issue. So again, we're mostly interested in politicians taking up the cause of basically doing a better job managing the budget. And so we'll see, again, how things unfold. But one thing that's happened, we think in part for worry about basically investing in government bonds, is some investors have decided to move money away from government bonds and into gold. And so there's been a big sort of increase in demand for gold, and that's seen in an increase in gold prices, right? And so we actually penned an article about this and would say that there was like this really almost like an emotional reaction, big buildup in gold prices. We do think and sort of described it as what we thought is overdone. And prices have come down a little bit, but we're just mindful that people are looking at that precious metal as an alternative store of value and as sort of a diversification away from, among other things, treasury bonds, for example. Now, turning to the economy, it's been an interesting thing to watch this year. We're only 6 weeks in, but when we started the year, the consensus view of 2026 growth was 2%, but firms, economists have been ratcheting up their forecasts, and that consensus is now 2.4. That's a pretty big move in just over a month, like 6 weeks. And so what's interesting is people are just increasingly optimistic about the economy here in 2026, again, tied to consumer activity, tied to business activity. That aligns also with our outlook. We thought above trend growth for GDP this year, and also a positive stock market, and we'll get into that. So turning to the markets, as we've talked about in a number of months now, for a number of months, interest rates remain elevated. So they remain stable but elevated. And so 10-year Treasury sits just around numbers 4.1%. And when we look at the yield available across all kinds of different fixed income categories, we see still elevated yields. And that just tells us, hey, there's opportunity to earn that yield and also have some diversification away from equities to the degree we see equity volatility. So we've seen a pickup in fixed income, more to move back to the category as rates have come up over recent years. And that idea of being diversified is viewed positively. Now, turning to stocks, we talked about this last time, but when we look back over decades, we see different makeups of the market, meaning who are the big companies in the index and in the markets. And so if we go back 40 years ago, energy, oil, was a big category, and it represented just over 20% of the market, the top 10 holdings in the index, if you will. When we look forward to end of 2025, of course, it's big tech that are dominating the top 10. And they represent not quite, but approaching 40% of the index. So how those companies perform are actually quite significant in terms of how the market goes. And so when we look at performance, basically last year, as we've talked about before, non-US stocks did really well. The big tech companies did well. That meant the cap-weighted indices did well. The equal-weighted indices still positive, but not as much. And then that layer of quality and yield had still positive returns, but muted compared to the cap-weighted indices. We've talked about a broadening. One of the reasons we see a broadening when we look at our long-term investment themes is we've seen these sort of shifts, in particular around artificial intelligence. So, and again, in our Outlook report, a nice article, Runway for Growth. But what we're seeing very pragmatically is regular old companies starting to implement AI in a variety of different ways, all with an eye towards improving productivity and improving, ultimately, costs, probably earnings, and an amplification, hopefully, of sort of services, the quality and volume of services that are applied are available from companies. And so there's a lot of optimism sort of driven into the environment. And right now the view is earnings growth is expected to climb or to be solid with positive and growing profit margins. And so again, we saw that market performance from last year. That has led to elevated markets, or for markets to remain elevated. So we're sitting at round numbers about a 22% premium on a PE basis to the 10-year average. That's on a cap-weighted basis, so those big companies having influence. When we equal weight, there's still a premium, but it's down to 7%. So we've called for a broadening, and so the data is showing that, meaning when we look at the data, non-US has still done pretty well in 2026, but the big tech companies have pulled back a little bit. The cap-weighted indices with the big dominance from those companies are about flat, so just above zero year to date. But the equal-weighted indices are up, in round numbers, call it 5%, and that quality and yield leaning is up 9 to 10%, depending on the index you look at. So, that reversal we talked about at the beginning of the year is actually showing itself. Now, as I mentioned at the beginning, one of the sort of circumstances right now relates to what we're calling AI dislocations, meaning when, as I hinted at, when companies that are delivering AI services announce what I'll call a vertical capability. So it might be related to software development, or it might be related to how software will be deployed, or it might be related to a specific function in financial services. What we've seen is a negative reaction from the traditional companies in those areas, but really where there's almost like a sell now, ask questions later kind of mood to it, where stocks just all go down in unison out of fear that AI capability is going to disrupt that industry. And our quick take on it was, and we've done a little bit of work since that quick take, we think that all of that's a little bit overdone, that basically one needs to, quote unquote, stay the course on process. So avoid indiscriminate selling, but do the work, or have your financial advisor do the work on companies that you're invested in, and basically look at the fundamentals, and then in a methodical way make that decision. Am I selling this position, holding this position, or potentially if it's down and you like the company, maybe adding to a position. And so that idea of AI dislocations is very much out and about, creating some volatility and some opportunity as we look around the markets. So I do want to make mention of just recognizing, and it's an interesting environment, that we've got, in addition to our base case view, a recognition that either more negative or more positive outcomes may unfold. And the bear case could be related to this AI stress or the consumer slowing down or maybe a misstep on policy. But then the flip side is true. We could see things a little better than expected. And I think on the economy, we're already there. There's people sort of calling for better than expected results compared to when we started the year. And then maybe the consumer gets fully engaged in businesses and things just go better than expected. So we're just, again, mindful of those scenarios, and we'll keep an eye on them going forward. Hey, that's really what I wanted to get into in this episode. Really appreciate you taking the time to check it out. I'll invite you to go to stifelinsights.com, as I always do, where you can find this work as well as a bunch of other things. So thank you again for listening, and we'll catch you next month. Thank you.
Thanks for listening to Stifel's Investment Strategy Brief. Be sure to subscribe wherever you're listening to automatically receive each month's podcast in your feed.